Hi, and welcome to Weldon Live for Thursday, May 26th. We go right to it. Jerome Powell, FOMC Board of Governors, governor, interesting speech today. I got to tell you, it's one of the more intriguing, thought-provoking speeches I've seen from a Fed member in a while. Don't want to get too caught up with Fed speak, but this was a really interesting one for some of what he said about productivity and longer-term dynamics in particular. But let's go to it immediately as it relates to the prospects for a June or maybe a July. We're in the September camp personally, although that may be too close towards election time. Who the heck knows? I mean, bottom line is, Powell is saying job growth is substantially faster than the underlying growth of the labor force, thus the unemployment rate dropping. Tentative encouraging signs of affirming in wages, which are rising faster than inflation and productivity. That last part is really important. So there is good reasons, and then he talks about GDP growth and retail demand and the consumer being a little soft. But he goes on to say there are good reasons to think underlying growth is stronger than recent readings suggest, and that labor market data will provide a better real-time signal of the underlying pace of economic activity. I always thought labor market data was a laggard. I mean, that's pretty much accepted theory, but Powell would have us think differently. And that's kind of interesting unto itself. Of course, there are risk factors. Despite the fact that they have waned, they're still significant. And it basically says they'll remain until significant underlying growth is seen around the world. In China, ongoing buildup of debt is notable. We know that. We've focused on it. We have seen it. And there was also some remaining uncertainty about the exchange rate policy. He talks about Brexit, and then he talks about emerging markets. Note that he puts in Venezuela. It's one of the places we've been very much focused on, especially now they're selling gold because they're running out of reserves as a result of what's going on in energy. Then he goes on to talk about low productivity. This is where it really gets interesting. Talking about the participation rate has fallen and hasn't recovered to the extent that you might if that decline was cyclical and there wasn't some kind of long-term, irreversible, crisis-related damage. That's interesting. Then he goes on to say one of the reasons that the participation rate is not growing like it might be, or frankly it should be, is because of the dynamics in the prime age group of 25 to 54. We have a 2% decline in the labor force participation, and that is well below what we've seen around the world. Whereas around the world, this has recovered after the crisis. In the U.S., it hasn't. Now, I might suggest, when you talk about your younger workers, there's a whole different mindset out there now in terms of wanting to have a job where you're 9 to 5 and where you're going to work for a company for 20 years. That doesn't exist anymore. It's a whole different mentality among the new generation. And then when we get to the older generation, you're talking about, it actually works in the opposite direction. People that thought they were going to retire actually still have to work. So it kind of cuts both ways. I don't know that this is as big a deal as Powell may want to make it out to be, but it's certainly intriguing to think about it, especially when we look at the charts. And this is from the speech that he did today. Productivity growth, clearly low, subpar, not strong enough. Capital spending, not picking up like it should. It's stagnant. And that is interesting in terms of, you don't have productivity growth because you don't have capital spending on technology and so on and so forth. That's actually good for the labor market in the sense that you're not taking away jobs through technology to increase productivity. So, again, all of this right now is such a double-edged sword. Watch what you ask for, you just might get it. You want an increase in productivity, that could slow the strength or growth in the labor market. Kind of interesting. Bottom line is, here is the 25 to 54, ranking all the countries. What's the participation? And you can see the U.S. is at the low end, for sure, in female population. But at the very low end, only Italy and Israel are below the U.S. in terms of the population working. You can see in the U.S., in females have recovered back to where they were pre-crisis, but not so among males. Still well below. That's a major factor in terms of why the participation rate hasn't risen. All of this combines to suggest that potential GDP is lower by almost a full percentage point, whereas the projections would have been, you'd be a 3% rate. Right now, the best case scenario, according to Powell, is 2%. This is the potential for GDP growth. I mean, that's just not good enough. It just isn't. And from that perspective, it kind of suggests, again, the way the Fed couches this is we're going to remain, gradual. We're going to remain lower than we would be normally. It's going to be low rates for the foreseeable future, not unwinding our balance sheet, so on and so forth. I would say this puts the Fed increasingly at risk of pushing on a string. Asymmetrical policy bias becomes a problem when you have, a one-third reduction in your potential GDP growth. That's pretty eye-opening for sure. Powell goes on to say rising real wages are pulling workers in and that this should continue and thus support investment and driving productivity higher. I don't know that this has caused an effect. Really don't. It'll be interesting to see, though. I mean, you get enough wage growth, for sure. You might get some spending on productivity growth. But right now, we don't see it. Certainly, there are concerns with the gradual approach. What's the main concern? Excessive risk-taking, unsustainably high asset prices, and credit growth. We know that. In fact, we see that. But what's interesting, he says, it's not certain that the tools, in other words, supervisory policies and macro prudence, would be adequate. Again, Fed kind of pushing on a string and maybe the other way, where they might have to remove policy accommodation more quickly to offset excessive risk-taking and unsustainably high asset prices. This is why they're puppeteering, because they really don't want to do anything. They're hoping they can talk the market to where they want it to be. Now, to actually hike rates, okay, you still need to see strengthening. This is still an if, quote-unquote, dynamic. It'll be important to see significant strengthening of growth in the second quarter. Increases in wage inflation. Right now, that's an if. It's not a given. And depending on the incoming data and evolution risks, a rate increase may be appropriate fairly soon. That's not saying we want to hike in June, and if nothing changes, we're gonna. That's not what they're saying. It really isn't. In terms of this exact dynamic, the most recent data from the Philly Fed, really interesting, their states coincident index. 42 states showed an increase, 7 a decrease, okay? The diffusion was 64, down from 70. In terms of 12 states reporting growth in excess of 1% over the last 3 months and 7 revealing an outright decline, that's a big shift from 15 states above 1 and 3 reporting a decline. Let's do this again. 15 above 1 and 3 reporting a decline last April to now 12 and 7. That's a fairly significant shift in terms of negativity state by state. As a result, what's interesting here is the volatility increases. The odds of a third rate hike by the end of next year, based on the December 2017 Fed funds futures, has been halved in the last 2 days, from 42% to 21%. That's interesting. In terms of a little bit of dovishness here, really didn't see that, knock the dollar down, didn't see that help commodities. Gold is still down, so interesting to note this. Still 20% expectation versus 0 a month ago. Still a little more hawkish.